Hi, and welcome to the second session on the mid-year review. After yesterday, we summarized with DealsAgent the M&A activity in the first 6 months of 2026. Now let's look at the PE acquisition activity and deal-making activity in 2026. Once again, you can use DealsAgent to ask a natural language question, and it will show you a source-based answer where you get the answers from. So without further ado, let's start with asking, as 2026 turn into a bigger year for deal making? So you see the answer comes from Bain. This is where the source of the data comes from. DealsAgent shows you insight, and it says, no, deal making dragged again. After a brief pickup, three stocks in quick succession, an AI-driven software apocalypse, private credit redemption stress, and the Iran war's oil spike. All those three shocks widened the bid-ask spreads and stalled activity. Q1 2026 buyout value was 173 billion, with Q2 estimated near 145 billion. So you see the graph that it generated, and you see the insight that it generated. So let's ask, how hard has technology deal making been hit? And again, it generates the insight. You see where it's from, Bain again, and it says tech took the sharpest hit. Deal value fell 70% from Q4 2025 to Q1 2026 as AI uncertainty clouded what software is worth. Large deals thinned out. The number of $1 billion tech deals dropped from 15 in the fourth quarter of 25 to 4 in the first quarter of 2026, and an estimated 2 in the second quarter of 2026. So how far did buyout software valuation fall in Q1? Let's ask this question. And the answer is private software marks fell 8% overall in Q1, far less than the public market correction, but still meaningful. The drop was much deeper in the US with an 8.9% drop than Europe with a 4.2% drop, while all other sectors marks were roughly flat. Let's ask, are buyouts as expensive as they've ever been? And you can see the insights that's being generated. Effectively, yes. Entry multiples have occasionally been higher, and rates certainly have, but the two have never been this elevated at once. So Bain's deal cost index, the median TEV to EBITDA multiplied by LBO loan yield, is in record territory, underscoring the need for operational value creation. And you see the deal cost index. Now let's ask, where is deal making headed in the second half? Because it's also predictive. And we can see that, again, DealsAgent took from Bain and generated an insight towards a plateau, not a recovery. Entra's NDA index, a leading indicator that historically precedes closing by 3 months, points to deal activity staying essentially flat through July 2026, stable, but still far from a broad-based rebound. And now let's ask, how weak are distributions to LPs right now? Distributions have run well below the 2010 to 2021 average of 25% for 4 straight years, 14.6%, 11.8%, 14.1%, and 13.4% in 2022 to 2025, respectively, implying a stretched 7 years capital cycle and growing pile of assets effectively trapped in portfolios. So, how much LP tolerance is there for exit markdowns? And you can see that it's limited. A majority of LPs starts to lose confidence once a full exit discount to the last mark exceeds 5%. Roughly a fifth accept no discount at all, and tolerance falls off sharply beyond the 0 to 5% band. So the next question is, are assets still existing above their marks? And we see that the answer is yes. The popover market marks hasn't disappeared. About 77% of buyout assets exit above their next to last quarterly mark and 71% above the final mark. broadly in line with history. Evidence that marks and realized exits track more closely than many LPs fear. So the next question is fundraising recovering? And the answer we get is not yet. As long as exit drag, fundraising follows, despite headline closing like KKR's North America Fund 9 and Bain's Capital Asia Fund 6, total private capital raised and running below the 2021 peak of 1.9 billion, with 2026 tracking around 1.3 billion, 1.3 trillion, that is. Are LPs pulling back their buyout allocations? And the answer is mostly holding, but a meaningful minority is trimming. The large majority of LPs are maintaining or increasing buyout allocations, yet about 1 in 5 is reducing exposure through the SAA process, driven by liquidity pressures or lower long-term return expectations. Again, you can ask any question from DealsAgent. It looks at the database, at reports such as Bain or any other PE report or anything within the data, and generates insights, really make it accessible to any analyst who want to slice and dice and infer anything from the data. Hope you enjoyed it, and tune in tomorrow.